Hey folks, let's talk here about our next subject. Not a real difficult one, but this is the gross profit method of valuing our inventory. Okay, the gross profit method, actually of estimating our inventory. Okay, now we know that from previous lectures that companies really need to take a periodic count of their inventory. Okay, they need to actually go physically count their inventory to either verify the accuracy of the perpetual records if they use a perpetual system, or if they use the periodic system, they need to take a count of their inventory to arrive at the inventory amount itself. Okay, so either way, you need to be usually at least annually taking account of your inventory. However, sometimes it is impossible or impractical or very, very expensive to take a count of your physical inventory. Now, a substitute for taking a physical count of inventory is what is known as the gross profit method. Okay? Now, generally accepted accounting principles does not let us use this method to estimate inventory for annual reports. Okay, but they will allow us to use it for interim reporting. Okay, so they do allow the gross profit method to determine ending inventory for like quarterly or interim reporting that a company might do, but it is unacceptable for annual financial reporting purposes because it is only an estimate that it provides. Okay, this can often be used too, besides interim purposes, if a fire happens or something like that, or if the inventory records are destroyed. But usually the main reason that we do this is for quarterly or interim reporting. Okay, now the basic relationship for this method was learned way back in Chapter 5 of Accounting 1. Okay, let's go ahead and review that. Okay, that is namely this, that the beginning inventory plus purchases, that equals something called cost of goods available for sale. Right? Remember this? Beginning inventory plus purchases equals cost of goods available for sale. Okay? Now, then we either, usually I think the way I taught it in Accounting 1 was I subtracted ending inventory to get cost of goods sold. But you could also, if you wanted, subtract cost of goods sold to get ending inventory, right? If 6 minus 4 is 2, then 6 minus 2 is 4. But either way, we know that this cost of goods available for sale, it's either going to be ending inventory or it's going to be cost of goods sold. Correct? All right. Now, understand that this relationship can be useful in estimating inventory at the gross profit method. Because really, I want you to think about this cost of goods sold. Another way of thinking about cost of goods sold is think about what it says. It's the cost of goods sold. It is the cost of goods that were sold. So if we take our sales amount and reduce that to cost, that's just another way of saying cost of goods sold. The sales value reduced to its cost is cost of goods sold. Okay, now remember this as we do an example. Let's take a look at an example. Okay. All right, let's take a look. Okay, assume that Cetus Corporation has a beginning inventory of 60,000 and purchases of 200,000, both at cost. Now sales at selling prices, this is at selling price, amounts to $280,000. Now that's what our sales were. That's what we sold it to the customer for, at selling price. Now, the gross profit on selling price is 30%. Now, what they want us to do is estimate the ending inventory using the gross profit method. Estimate the ending inventory using the gross profit method. Okay, well, let's go ahead and do this. And again, let's think of this relationship up here. All right? Okay, we have our beginning inventories plus purchases, and that's goods, and let's say cost of goods available for sale. Okay, now what are those amounts? Well, the beginning inventory is valued at $60,000. Okay, our purchases are $260,000. We add those. Whoops, sorry. Our purchases are $200,000, right? Beginning inventory is 60, purchases of $200,000, and our cost of goods available for sale, that's what is $260,000. Are you with me? Okay, once again, beginning inventory is 60, purchases are 200. That equals $260,000 cost of goods available for sale. Okay, let's take a look now at what we do next. Okay, what we have to do now is analyze a new relationship. We have to remind ourselves what the gross profit really is. Okay, well, sales minus cost of goods sold equals gross profit, or sometimes we call it gross margin. Okay, now when they tell us that gross profit, the gross profit on selling price is 30%, that is 30% of whatever sales is. Okay, sales is 100% of sales. The gross profit is 30% of sales. Thus, the cost of goods sold is 70% of sales. Okay, if the gross profit is 30% of sales, then the cost of goods sold has to be, in this instance, 70% of sales. Does that make sense? So, what is our sales amount? Our sales amount is $280,000. Okay? Well, they're telling us that gross profit is 30% of sales, which would be 30% of 280,000, which is 84,000. So what is our cost of goods sold using this relationship with the gross profit percentage they've given us? Well, cost of goods sold is 196,000, right? Now you really didn't have to do this bottom step, since we knew that cost of goods sold was 70% of sales, and they gave us sales at 280. We could have just taken 70%. But now we know our cost of goods sold, right? Now we know our cost of goods sold using this estimate method of gross profit. Our cost of goods sold is $196,000. So, if we know our cost of goods sold, and we know our cost of goods available for sale, well, that minus that is going to equal our ending inventory, right? Thus, ending inventory has to be $64,000 as an estimate, because 260 minus that needs to equal that, 260 minus that needs to equal that. We backed into this number, thus we can compute our estimate of ending inventory using the gross profit method, and in this example, we got $64,000. So not real hard, but you just got to kind of remind yourself of these relationships.